Hello and welcome to the latest Luna quarterly update. My name's Alex Brandreth and joining me today is Seldian Curri, Deputy Portfolio Manager at Luna. Today we're just going to give a bit of a run through with the key events that happened during the quarter, what happened to markets, and just give a little bit of an outlook as well. So the key themes for the quarter, first one is artificial intelligence. We can't seem to get away from it. We're actually adopting it more and more at Luna in our day-to-day work. And it certainly is a help in the development that's going through, but it's having a big impact on the markets as well. We saw a lot of the companies deliver very robust earnings in the second quarter, which propelled tech stocks around the world higher. I think there's been a lot of focus with what's been going on within the US and technology, and rightly so, the growth of Nvidia. But there's AI beneficiaries all over the world, and so I'm going to touch on it later, but Japan was one of the best performing markets during the quarter, and that was driven by, well, one of the factors was artificial intelligence. The next key development that happened is the Middle East conflict. As we came into the second quarter, this was really just kicking off. It's been a volatile quarter. It feels like these peace talks have been on and off, but it now looks like that we've got an agreement in place. And markets have reacted accordingly, and we'll touch on that. And finally, UK politics. It would be a mistake for us not to mention the fact the Prime Minister's resigned during the quarter and what the impacts that's going to have on markets. So we'll touch on that as well. So one of the key things that we get asked all the time is, what are technology stocks too expensive, and can they keep delivering? And these charts here really highlight why technology shares have performed so strongly over the last few years. On the left hand side here you can see earnings per share. We've just put US technology in green there and compared it to other markets like the US, UK and Europe, and you can see how it's really taken off. On the right hand side you can see profit margins, and they're following the same trajectory as well. So not only are these businesses delivering, but they're delivering high earnings for shareholders, and they're delivering decent profit margins and justify what's been going on. In terms of the Middle East, as I mentioned right at the outset, a resolution has now been agreed. What does that mean? Well, we've got some charts on oil in a second I'll touch on, but commodity prices have fallen from their highs, which is a benefit to inflation expectations. When commodity prices are high, and we've seen this in the past, that can feed through in terms of high levels of inflation in the UK. And the negative side to that is when things cost more, you spend less. That means economic growth's weaker. So again, the developments with commodity prices coming down, inflation not being as elevated for as long, means that economic growth can rebound and be stronger. But one of the key things that we were saying at the beginning of this year was that interest rates are likely to fall probably 2 times over the course of this year. After the conflict in the Middle East started, that was off the table. We didn't see any interest rates being cut at all in the UK, and you've actually seen interest rate hikes in other parts of the world. So in terms of what happens next, we still think that the central banks want to reduce interest rates, but inflation is going to be a bit stickier for a bit longer. So maybe the cuts that we were expecting this year feed through into next year instead. This is the point that we made on oil. This is a 5-year chart, so purposely done for 5 years because it goes back to the start of the Russia-Ukraine conflict as well. And you can see the spike right at the beginning of that chart when that started. And for 4 years or so, oil was trending down after that. And you can see what happened as we entered in 2026 and the conflict started. Oil went from $60 a barrel up to $115 at one point, and we're now back down to $73. So it has been a dramatic increase and fall in the price of oil, which again, as I mentioned, is key for inflation. Now I'm going to hand over to Seldian now, and he's just going to touch on how this impacted the equity markets in the second quarter.
Thank you, Alex. So the second quarter was very positive for equity markets. As we can see, the standout performer in the Q2 was the Japanese market, with Nikkei delivering 32.4% in sterling terms. That was followed by the American market, US delivering strong returns, technology leading the way with Nasdaq delivering 26.8%, and the S&P 500 delivering 14.4%. Europe had also a very solid second quarter, delivering more than 12% in sterling terms. When it comes closer to home, FTSE All Share delivered a solid 4.7%, but by being more defensive in nature, it hedged very well during the first quarter with the oil price spike that we saw as the conflict intensified, and that's why in the Q2 it has been a laggard to other markets. The exception in equity markets was the Chinese market, with the Hang Seng being down 7.12% for the quarter, as the Chinese government has a growth target of 4.5 to 5% that has weighed on sentiment. And as we've seen historically, so the world has been through many other major oil crises and shocks, and initially the effect has been very significant, but the history has taught us that the world has always moved on, and markets have recovered after every oil crisis that we've gone through, and recovery this time seems to be quite quick and fast so far. So that shows that it is important to remain invested and ride through volatility. And again, this chart shows us that almost every year we experience significant drawdowns while being invested. But if we take the money out of the markets, when those drawdowns happen, we miss the rally that comes after them. And so, again, emphasizing the importance of staying invested, even when it is difficult psychologically to remain invested when we experience these kind of shocks in the markets. Now I hand over to you, Alex.
Yeah, perfect. I mean, I think that some of the numbers there are blockbuster. Some of the returns that we've seen during the quarter. Japan up 33%, is quite staggering, really. But now, obviously, it's coming from a low base after the sell-off that we saw in March. So, UK politics, we don't have a crystal ball, I apologise, but what's been happening, as we said, the Prime Minister's resigned, and it looks like Andy Burnham's going to be the next Labour Prime Minister. I think what we're just taking a step back, and if we think about all of the things that led the Prime Minister to resign, you had what's been going on with Mandelson, you've had issues with Donald Trump, and it's been one thing after another which has really impacted his reputation. And through the second quarter, while he was still Prime Minister, that was really causing some uncertainty within the bond market. And one thing that we'll always say, and apologies if you heard us say this a million times before, is that markets don't like uncertainty. And the bond market particularly has been focused very keenly on the UK bond market over the last few years because of the high levels of debt that we have. So it wasn't a very pleasant ride for UK government bonds. But while the market doesn't like uncertainty, now we have certainty. We have certainty in terms of the President. The Prime Minister has resigned, and that's definitely given us some certainty. Now, what next for Andy Burnham? The market was also quite worried about his fiscal policies and his fiscal rules in terms of, is he going to come in and ignore the bond market? And we've seen this in the past, which has caused unrest within bond investors. But what has pretty calmed markets down is the fact that he seems to be surrounded and being advised by some pretty well experienced, calm heads. So you've got the former OBR Richard Hughes chair, you've got Lord Jim O'Neill, who's a very famous chief economist at Goldman Sachs, and an ex-Bank of England chief Andy Haldane. So they're all there to help him and support him in terms of what the fiscal policy should be for the UK going forward. And the other thing that Andy Burnham's come out and said, which was quite key, is commitment to the fiscal rules. Our debt sustainability is incredibly important. We have the most amount of debt that we've had outside of wartime. We're about 100% of debt to GDP, so it's extremely high. So we need to keep our debtors happy and show that we're being prudent with what we're doing. And Seldian, and then what's happened in terms of inflation during the quarter? It's dipped actually. I mean, it's quite surprising. It caught a lot of people off guard, but inflation actually has dipped during the quarter when everyone's expecting it to move higher because of the move in the oil price. But you can see here the inflation did fall quite slightly. That's because of core services, which is that blue bar coming down there. As we move into the rest of the year, though, we are expecting it to pick up. Not to the levels that we saw in 2022 and 2023, but we expect inflation to move higher because of this impact from the oil price. But as I said right at the beginning, we expect that to be short-lived and inflation expectations to come down as we move into next year. Over to Seldian, he's going to touch on the volatility that we saw in the bond market in the second quarter.
So Q2 was a very constructive quarter for fixed income. With all major fixed income sectors delivering strong positive returns. Global emerging markets led the way with a 4.3% gain during the quarter. They were followed by the UK corporate bonds with 2.9% gain. Gilts delivered 2.1%, whereas the strategic bond sector delivered on average 2.6%. It was not a straight line. Bonds went through a period of volatility in May with the UK gilts and corporates touching negative territory, and then they were followed by a June rally where they touched quarter highs. The fact that the global emerging market debt and corporate bond sector delivered better returns for the quarter, that shows that investors were rewarded for taking investment interest risk over rather than duration risk. I think they're the key points. I think that's the reason for the volatility is the political backdrop in the UK, which is what we were touching on earlier. So just to summarise then, an end to the conflict is positive for everyone. It's positive from a humanitarian perspective. It's positive for Iran, it's positive for the US, it's positive for the global economy in terms of getting oil and other commodities shipped through the Straits of Hormuz, which has been closed since the conflict has begun. So, a positive there for the global economy. As I touched on, I don't think we're going back to square one. Some of the infrastructure damage that has been sustained on Qatar in the natural gas field, that's going to take 3 to 5 years to fix. So we're not expecting commodity prices to go back to really low levels, and there's going to be a bit elevated for a period of time. And also we're working through this kind of supply glut that we've been, lack of supply from oil more recently. So we are expecting inflation to pick up in the short term within the UK. But the positive news is this is great for growth. It's great that this conflict has ended, and people can start focusing on a day-to-day. And I suppose that's what the key thing for the markets have done during the quarter. They've been focusing on corporate earnings, which have largely delivered during the quarter, despite the kind of volatile macro backdrop that we've been living through. And who knows what the policies of the incoming Prime Minister will be and who he elects as Chancellor. And we'll continue to monitor these developments, but that's going to be key going forward in terms of what we're looking for. And as we'll always say, we go through bouts of volatility all the time. We have a drawdown in markets on an annual basis. Events come along all the time. It's important for us, important for yourselves, not to get too drawn into short-term volatility and focus on longer-term goals. We spend a lot of time sitting down, talking during periods like this and thinking, do we want to make changes? Are we happy with our positioning? But not doing so on a 5-minute basis, thinking really longer term in terms of what we're doing. That's all from us. On behalf of Seldian and myself, I'd just like to say thank you for listening today.
If you do have any questions on this or your portfolio or anything else related to Luna, please feel free to contact one of the Luna team and we'll get back to you. Thank you very much.
Thank you.